It's my pleasure to be with you today to introduce you private equity as an asset class. It's my favorite subject. I could speak hours about that, but I will try to make it in 20 minutes to cover this asset class. It's private equity is not as new as infrastructure as an asset class. It's around 30 to 40 years old, even older in the United States. But I can confirm that infrastructure, which has a lot of similarities with private equity, is really an asset class which is developing very fast. And for example, in our activity for our institutional clients, life insurance, like Swiss Re, now infrastructure investments account for 20% of our assets under management against 80% for private equity. So growing very rapidly. And we, on the most recent programs that we have for these clients, it's about 50-50 invested in infrastructure and private equity. Because you will see that there are a lot of similarities. In particular, it's an illiquid asset class, and the value creation really stems from the quality of the assets that you buy, not from the performance of the market. You will see that in the presentation. I have a problem with the slides. This one? It's in the other direction. Okay, thank you. So there will be three parts in this presentation. First, a quick reminder of what is private equity. Then we'll discuss the merits of investing in private equity, why investing in private equity. And third, we will explain the specific characteristic of this asset class. So, private equity is the purchase of equity in private-held companies, in general with a purpose to hold the investment for long term. What we call long term is typically 3 to 7 years. So why keeping investments 3 to 7 years? Because the investment thesis is based on a transformation of the companies that the fund managers buy. And in order to give time to the managers of the companies to transform the companies into better companies, so for example, larger companies, more profitable companies, more diversified companies, and to sell them at a higher price for a higher strategic value, they need time. So private equity is really a long-time bet compared to public equity investing. Is there a lot of difference between private equity investing and public equity investing? The answer is very much so. So one of the main differences is the origination of the deals opportunities. In private equity, you can buy easily assets because they are tradable. You can find them in the market. Private equity origination is key. You need to find the assets, you need to have a network for that, and then you need to negotiate the purchase of the asset. You are, in general, in competitive situations, so it's not so easy to transact on a private companies, less easy than to buy public stocks in the market. That's one of the main differences. The other difference is that you don't have a price which is set by a market. The price is the result of a negotiation between a seller, a buyer, and the management, because the management of the company is always involved in the private equity transactions. Why? Because most of the time they are stakeholders in the company, they are shareholders in their company, or they have an incentive to be successful in the private equity investment. So the acquisition of a private company is based on a contract between the investor who buys the company and the management. So it takes time. Usually they agree on a business plan, and then it's up to the management to execute the business plan and to the private equity holder to help the management in executing the business plan and then exiting the company. So very different from a public equity investment. Then the last point is once the private equity manager owns the company, there is a lot of work, a lot of monitoring, a lot of influence of the shareholder into the company. Of course, it's up to the management to manage the company, but the private equity firm helps for the different development of the company to take place. For example, making acquisitions, for example, reinforcing the management, and sometimes, if the manager does not deliver on the plan, change the management. That's the responsibility of the owner, which is the private equity fund. So that's what we call usually active ownership. So the job of a private equity fund is very different from the job of a public equity fund manager. There are two types of, to make it more simple, two types of different transactions that you can find in private equity. In private equity, either you invest in a company to develop it by putting money into the company, participating to a round of financing, participating to an issuance of new shares to develop the company. That's typically what venture capital funds do. You invest in a company which is not necessarily profitable in order to develop it. So the money goes into the companies. The other part of the investments that you can find, the type of transactions that you can find in the private equity space are the change of ownership. You solve an ownership problem into a company. So you give your money to a seller, for example, a corporate or a family who need to dispose of the assets for any reason. Then the company does not, the money does not go into the company, the money goes into the pockets of the seller. In that type of transaction, which is called a buyout, and if it is financed with the help of leverage, it's called a leverage buyout, LBO. The key is to buy a company with very solid cash flows, very solid market position, in order to be able to reimburse the debt that you need to raise in order to finance this acquisition. So private equity transactions play very different roles from very small companies, even startups, to very mature and very large companies. You can find private equity transactions in all the type of companies that you can see, starting from creation, that's called seed financing, to buyout and even rescue financing if a company is in a difficult situation or turnaround. The largest part of the market, around 80% of the money which is invested in private equity, is not in venture capital or growth financing, it's in buyout transaction. You have to have that in mind. Most of the time, in the newspaper, we talk about very successful venture capital type of investment, but the reality of the market in private equity is that 80% is leverage buyout type of transaction, which are much less risky. The loss rate is around 20% or less, whereas venture capital investing can generate higher returns, but with a much higher risk. Typical loss ratios that we can see in the venture capital funds are around 50%, sometimes more. So why investing in private equity? Is it really an attractive asset class? The way we see it is that private equity is a diversification to a portfolio. That's the main benefit of having private equity in a diversified portfolio for institutions is diversification. How do you get that? And the second benefit of investing in private equity is looking for outperformance, because you will see that on a long-term basis, private equity has outperformed the other asset classes. Why is it a diversification? First, because it's not the same type of transaction. Second, because the value creation in private equity is really driven by the stock picking and by the action that you take to transform the companies. A typical buyout fund, which is 80% of the market, is 10 to 12 companies. Nothing to do with a very diversified index. So it's not a bet on the growth of the macro in general. It's really a bet on the company and on the ability of the management to transform this company and make it more valuable for potential purchaser. So it's very different dynamics than the public markets. We have shown some numbers of performance so that you can see that it is quite comparable from one company from one country to another. For example, in France, on average, in the last, between 2004 and 2013, which means mature funds, which are already showing positive returns, the average IRR is around 11%, very comparable to performance in the UK and very comparable to the performance reached in the USA or in Germany. So during this period, it's between, let's say, 8 and 11% net IRR for the investors. This compares favorably to other asset classes like public equity with a premium of around 2 to 3% for illiquidity and hedge funds. You know better than we do for these asset classes. Real estate is around 7% and fixed income due to the decrease in interest rates around 5%. So very solid returns across the countries in the developed countries. Returns are not so good in emerging countries, although growth is higher, which clearly shows that the performance of private equity is not directly linked to the GDP growth. But having said that, one of the characteristics of this asset class is that there is a lot of dispersion around the performance of the funds. So you have to be very careful in manager selections. The quality of the GP is really key. If you look at the statistics since the beginning of, so the longest statistics that we have start in 1990, so about 30 years of history of private equity. From 1980 to 2007, the median IRR of private equity funds is nearly zero. What does it mean? It means that one fund out of two did a loss, and one fund out of two had a positive return. But the average return is around 11%. So a very big difference between the average and the median return. What does it mean? It means that a lot of small funds, in particular technology funds, did perform very poorly, driving the return, the median return, very low. At the opposite, the mid-sized funds as well as the large fund did perform very well. So if you had invested in a portfolio of all private equity funds, according to their size, your average return would have been around 11% on the very long term. But if you had equal weighted your investments in all the funds, your performance would have been around zero. Very, very interesting. So that's why, for example, for ourselves, we clearly prefer to invest in established fund managers which have demonstrated their ability to create value, because we have a lot of initiatives with poor results. And if you have been very good, that means if most of your funds were first or second quartile, then your IRR is even better than 11%. So an attractive asset class with a real potential for outperformance, but if you are very careful in your selection. So how does it work? It's a bit complicated for those who are not familiar with private equity. First, private equity use special types of vehicles, called closed-end funds. So in the UK and the US, you call them limited partnerships. Why limited partnerships? The investors are called the limited partners, and the manager of the fund is called the general partner. The general partner takes a risk, which is not limited. whereas the limited partners, the investors, their risk is limited to the money that they bring on the table to invest in the fund. So their commitment, they cannot lose more than their commitment. Their responsibility is limited versus the general partner, by opposition to the general partner. Typical structure is also different from a traditional funds in other asset classes. The general partner is entitled to a management fee, like any other fund, usually in the range of 1.5 to 2% per year, which is quite expensive, actually. Which is very important, an incentive, which is called the carried interest. And the carried interest is a share of the capital gain in absolute terms. So there is a clear alignment of interest between the general partner, the manager, and the investors. It's not a performance fee based on the year results. It's at the end of the fund, which is typically a 10 to 12 years fund. If the investors have made a positive return above the threshold, which is called the hurdle rate, which is generally between 6 and 8%. If capital gains exceed and return exceed this hurdle rate, then the general partner is entitled to a portion of the capital gains, which is generally 20%. In infrastructure funds, it's more in the region of 12 to 15%, but it's larger funds. And in private equity, it's usually the standard is 20%. So expensive funds, but a clear alignment of interest between the manager and the investors. The other point is that, generally speaking, the investors expect from the general partner, the managers, to put their own money in the fund. And they do it sometimes very significantly. You have managers who invest 5 to 10% of the fund, their own money. So there is a real alignment of interest, which I believe is a very positive aspect of this asset class. You don't have the same type of alignment of interest with the traditional asset classes. So how does it work in terms of fund life cycle? So in order to raise a fund, usually it takes between 6 months and 2 years. That's the marketing period. So the GP visits the investors and tries to get as much money as possible for his fund with a target which has been set up. Then the fundraising is closed. The size of the fund will not move, and the managers will invest the money during 5 years by companies. Typically, as I explained, 10, 12, 15 companies in the portfolio during 5 years. Then it's the so-called harvesting period, which lasts around 5 years, where the fund manager will try to implement value creation strategies together with management of the companies and sell the companies to a new owner. This is the harvesting period. During the fundraising period, the manager calls the money. So when you invest in a private equity fund, you are not called 100% day one. You are called during 5 years while the fund is investing. It's different from the other asset classes. And when the general partner sells the company, then the general partners send you distributions and you receive money back. The general partner is not allowed to reinvest this money. That's called the harvesting period. Usually, the typical private equity fund is 10 years, with potential 2 years, 2 times 1 year extension at the discretion of the GP or with the approval of a majority of the LPs. So typically, it's more 12 years than 10 years. So it's long-term investing. Once the fund managers has invested, let's say, 80% of the amount, so in year 4, for example, during the investment plan, he starts raising a new fund. Why? Because if he doesn't do it, he has no more money to invest. So he's starting a new cycle. So he's coming to visit its investors, try to explain what he did, and if they're happy, they are committing to the new fund. And investors invest in the new fund, and in the meantime, receive money from the older one. That's the way it works. So this illustrates the cash flows. So in red, you have the negative cash flows, so the inflows for the fund, so the drawdowns. So typically during 5 years, you are called, and you have to pay. You have no choice, if you have committed to a fund, to finance the acquisitions. In the meantime, you have some companies that are maturing and that are being exited, and the general partner sends you distributions. There is a one point in time where distributions exceeds the drawdowns, and so the net cash flow becomes positive. But you have to be patient. Private equity is really a long-term play. Before you get in a positive territory where the distributions exceeds the capital which has been drawn. That's what we call the J curve. So once you are invested in a private equity fund, what can you do except waiting until the money comes back? It's invested first and comes back. The reality is that you cannot do a lot of things because there is no real market. The fund is not quoted. The companies which are within the portfolio are not quoted, and you have nothing to say to the GP. You cannot force the GP to accelerate the sale of the companies. You are committed to his fund. You have to trust him and wait until he creates value and sends back money. Having said that, the reality is that there is some liquidity in the asset class. It's quite recent, less than 10 years ago, actually, which is called the secondary market, which has developed quite significantly. The secondary market is a market where people can buy interest in funds from existing LPs who want to dispose of their interest in the fund. Because you may need, as an investor, to get liquidity. You knew when you invested that it was for 10 years, but sometimes you need, for any reason, to dispose of some of your investments to find liquidity. So the secondary market was very small a few years ago, and very illiquid and with large discounts, because one of the problem is that when you sell your interest in the fund, usually the potential buyers offers you a price which is less than the net asset value of the fund. There is a discount. It can be more or less depending on the market situation. But today, there are a lot of secondary funds who specialize on buying LP's interest. There is more liquidity and prices are much better with lower discounts. So the asset class is in fact less illiquid than it used to be, still illiquid, but less illiquid than it used to be in the past. And to give you an idea, last year, private equity funds raised around $400 billion. And there were around $40 billion which were transacted on the secondary market. That means that approximately 10% of the funds which have been invested in secondary transactions. So it's quite significant, 10% of the interest being exchanged in 1 year. And this number, this $40 billion, is more or less similar to 1 year ago and 2 years ago. So today, the secondary market is really a deep market for private equity interest. So it's interesting to have this market. One question that is often raised by institutional investors before making decision investing in private equity is how do you evaluate companies? Because they are unquoted, there is no price on the market. How do the GPs evaluate the companies in their portfolio? The first thing to say about that is that it's now very standardized. Most of the general partners, the private equity funds, are in countries where there is regulation. It's the case in France, the case in UK, Switzerland, Luxembourg, everywhere. So there are rules and practice. So what are the methodologies that are used? The GP tries to evaluate the companies at what they call the fair value. So the most frequent methodology which is used is comparable, multiple comparable to public companies. So they have a set of public comparables. They look at how they are priced by the market. Usually the metric which is used is enterprise value in terms of multiple of EBITDA. then they take a discount because usually it's smaller companies or illiquid companies, and they try to set up a price like this. What is important is that when they sell the company above the price that they have in their books. But it's quite a solid methodology. Yeah. So key features for the asset class. First, private equity is really a long-term play because you need to transform the company. Typically, investment are for 10 to 12 years, and the time to build your portfolio, you have to take into consideration 15 years if you don't want to take too much vintage risk. It's illiquid, but less in the liquid than in the future, in the past, sorry. Performance is high, but really relies on the quality of the GP, so we have to be very careful to GP selection. And one of the characteristics of the asset class is that the managers are looking for absolute performance, not performance related to a benchmark. So absolute returns, in general, above 8% net IRR for the investors. And there is a risk which is associated to this type of investment because it is illiquid, because it is equity, even if it's private equity. So you cannot exclude that you have a risk on an investment. You cannot exclude that a fund is making losses, but when you have a diversified portfolio, it's a real risk that you can really easily mitigate. Thank you.
Thank you. Thank you very much.
Okay. Thank you.
Thank you.